We're going to pick up here with our concepts of assets, liability, and owner's equity to talk about the accounting equation. Assets in our equation equal liability plus owner's equity. So assets are going to be on the left side of the equation by themselves on the in front of the equal sign. And then liabilities and owner's equity are on the right side of the equal sign. And our assets must always equal our liabilities plus owner's equity. If they don't, we are out of balance and we need to stop and go back and figure out what's going on. So this equation must always be true. Here's an example. If our business has total assets of $60,400 and total liabilities of $5,400, what is our owner's equity? Now, remember our equation. Our total assets equal our liabilities minus owner's equity. So, a little bit of algebra here, just a little bit, I promise. Oops. So when we have our assets here, and so we're going to use algebra and we're going to move the liabilities to the other side of the equal sign. So whatever we minus from one side, we've got a minus from the other. And that gives us assets minus our liabilities equals owner's equity. From a practical standpoint, again, if we had $60,400 in assets and we sold those and used that money to pay our debts, which is $5,400, what we would have left after we did that would be $55,000. And that's our equity. But remember, we don't actually have to sell our assets. We just have to know what the value of our assets are and what the value of our debts are so that we can have that owner's equity figure based on our accounting equation. And so we're going to look at some business transactions. A business transaction is going to be some sort of an event that is going to have an economic impact on our business. It could be as simple as a customer coming in and purchasing something from us, but it could get far more complex than that. And I don't want to confuse you by giving you examples of that. But it generally requires an exchange with an outside entity, so not transactions that would occur within the organization, and that we've got to measure that exchange in dollars. And we're going to use a separate record to summarize the changes as it impacts the asset, the liability, and the owner's equity. And I know this is Greek, but just hang with me. So when we're looking at a business transaction, we've got to ask ourselves three things. What happened? What accounts were affected? And how does that change the accounting equation? So let's first focus on what happened. What event took place? Did we sell something? Did we buy something? Did we borrow money? What accounts are going to be affected? So did this affect an asset account, a liability account, an owner's equity account, or multiple of those accounts? And what impact does that have on our accounting equation? Did we have a decrease in assets and an increase in liabilities, or vice versa? So now we're going to look at the effects of business transactions on the accounting equation. We've got Rohan Maxon, who is an owner, and he invests $2,000 in a business. So, what is that? How do we categorize that transaction? We've got Rohan, who takes money, this is $2,000 from his personal bank account and puts it into the business bank account. So he has taken, now the business has two things that are impacted. It's got some cash, and Mr. Maxon has now equity in the company, because at this point we don't have any liabilities. So we've got our asset with it, which is cash. If we think about our accounting equation, assets equal liabilities plus owner's equity. We have zero liabilities at this point. So we've got $2,000 in cash as an asset, which then means Mr. Maxon has $2,000 in equity. That equation will change if we incur some debt. And so in both instances, we have two different accounts that are impacted, and each was increased by this transaction. And that won't always be the case. But in this case, we buy the business receiving cash, we increased our cash, and Mr. Maxon's equity increased. And as I said, we've got zero liabilities. So we've got $2,000 in assets, no liabilities, $2,000 in equity, and so we are in balance. What is on the left side of the equal sign must equal what is on the right side of the equal sign. And right now we're in good shape. But as you can imagine, life moves on, and we have another transaction. Our company purchased delivery equipment for $1,200 in cash. So we ask ourselves, what accounts are affected by this transaction? Well, we got some equipment, and so our equipment is an asset, but we had to spend some cash to get that equipment. So we had an asset account that increased, and we had an asset account, our cash went down by $1,200 when we paid for that purchase. I guess I should, my explanation's a slide ahead, I apologize. So now let's look at our accounting equation. The only accounts that were impacted by that transaction of the purchase of equipment were asset accounts. Our cash went down by $1,200, but our equipment went up by $1,200. Nothing happened over here. It didn't impact his equity. His equity stayed the same. It just, the asset picture of the company changed, but it didn't change the overall value. And we remain in balance. And it should still have his equity over here. When we do this. Okay, so now we can see we've got our cash, which we started with $2,000. We spent $1,200 on equipment. We have $800 left over. Now, delivery equipment, we started with nothing. We purchased $1,200 worth. And so now we have $1,200 in delivery equipment that we didn't have when we started out our business. And these two together still add up to the $2,000 in assets that we started with. And again, with zero liabilities, our owner's equity hasn't changed. Now we're going to buy some delivery equipment on account for $900. And he's going to make payments on it over the next 3 months. So because he's going to make payment on account, he didn't put any money down. It's just strictly a financed purchase. So now how that is that going? Well, we now have more delivery equipment. It impacted our delivery equipment account, and now we have a liability of accounts payable because now we owe a business for that delivery equipment that we haven't yet paid for. We have an increase in an asset account. We have our more delivery equipment, and now we have more liabilities. We now have an accounts payable that we didn't have before. And so again, plus 900 on the delivery equipment, which is on the asset side. And now we have 900 in liabilities. Still no impact on our owner's equity. And hopefully, if it's not clear, it will be in a second. Because what happened on the left side and the right side of this equal sign balanced each other out. We didn't have to dip into equity to make our equation balance. So let's just focus for a minute on just the asset side of our equation and what happened, or what has happened since we established our business. We started out with $2,000 in cash. We used some of it to buy some stuff, which left us with $800 in cash, and we still have $800 in cash. We started with no delivery equipment. We first bought $1,200 in equipment, and then we bought another $900 in equipment. So we have a total of $2,100 in equipment, and we have $800 in cash still. So we have total assets of $2,900. Now we're going to shift and look at the right side of the accounting equation, which is our liabilities and our owner's equity. We started our accounting period with no liabilities. We then incurred $900 in debt. So we now have a $900 balance in our liabilities. And our owner's equity started out as $2,000, and it's still $2,000. We haven't touched it. So if we add our liabilities and our owner's equity together, we get $2,900. Now, what happens? We're going to make a $300 payment on the equipment loan. So let's look at first what accounts are going to be affected by that. So $300 is going to come from our cash. And what are we going to use that toward? We're going to use that toward the accounts payable, which is the liability. And so our cash is going to be decreased by that $300 payment. And our accounts payable, this debt we owe, is also going to be decreased by that $300 payment. And so again, this is the only accounts being impacted here are our asset account and our liability account. We still haven't done anything to affect our owner's equity. And we remain, because these accounts balance. So now let's look at the asset side of things. We started with cash of $2,000. We spent $1,200 of it, which left us with $800. And then we spent $300 more of it, which left us, we now have $500 in cash. On the equipment side of things, we started with nothing. First, we purchased $1,200 worth, and then another $900 worth. So we have a total of $2,100 in equipment. If we add together the cash we have left to the equipment we purchased, that gives us $2,600 in total assets for our company. On the right side of the equation, Again, we started with no liabilities. Then we have a $900 liability as a result of some equipment we bought. But then we made a payment on that of $300. So we have an ending liability balance of $600. We still haven't touched our original owner's equity account of $2,000. So if we add these two together, the accounts payable and the owner's equity, that gives us $2,600. And lo and behold, that's the total of our asset account too. So in our equation of assets equal liabilities plus owner's equity, we remain in balance. What is on the left side of the equal sign equals what is on the right side of the equal sign. There are four kinds of transactions. You may be saying to yourself, well, okay, we've done a number of things so far and nothing's touched owner's equity. Why not? There are four kinds of transactions that are going to impact your owner's equity account. And those are expenses and drawing. And when I say drawing, I don't mean like coloring. I mean the owner deciding he's going to take some money out of the business, remove some of the equity, and I don't know, go do something with it. But he's going to take it out of the business for his own separate purposes. And so those two things decrease owner's equity. So when the company incurs expenses, that decreases equity. And when the owner takes money back out of the company, that similarly decreases his equity. So then what increases equity? Revenue. So when we make sales and things like that, and investments. So if we invest some money and we earn interest or something like that, or receive dividends, that will increase the equity as well. And I'm actually going to stop here and move on to the next video to talk about revenues.